Hello one and all. Today I'll be talking about GARCH model and its application in predicting volatility, and it can be used in your option trading. Many of you would have heard the name options and its option trading, and many of you may be actively trading or passively trading. Today we will understand what is GARCH model and its importance. Myself, Dr. Narayan, and today I'll be giving you introduction about GARCH model. So let me share my screen. Okay. So what is GARCH model and its importance in option trading? So option pricing is influenced by following option Greeks. Delta, that is the probability influenced by the change in the underlying. Gamma, that is the rate of change of delta. Theta, that is the time factor, especially if you are selling an option. Vega, that is the volatility. Volatility plays a very important role in option pricing as per the Black-Scholes-Merton model. Many times, specifically in stock options, you would have seen the value of the underlying remains the same, but both call option and put option value may suddenly spike due to sudden spike in volatility, and many may not understand the reason behind it. That is because of the increase in the implied volatility. So what is GARCH model? GARCH model is generalized autoregressive conditional heteroscedasticity model. It is a statistical model used in analyzing time series data where the variance error is believed to be serially autocorrelated. These models assume that the variance of the error term follows an autoregressive moving average process. Why modeling a financial series is a complex problem? Because of the complexity is not only due to the variety of series, but also stock exchange, interest rate, unforecasted events happening, so on and so forth. Importance of frequency of observation, statistical regularities, existing of statistical regularities that are common to a large number of financial series and are difficult to reproduce artificially using stochastic model. In stock market terms, a rapid price fluctuation in either direction is considered as volatility. And high standard deviation value means the prices can dynamically rise or follow. You would have seen some stocks which are highly volatile, such as Adani Enterprises, but there are certain stocks such as Hindustan Unilever which are less volatile. Means you can expect a sudden spike in the price either in the upward or the downward direction for highly volatile stocks such as Adani Enterprises and Z Limited. So how is volatility classified? More than 1% change in the index or the more than 3% changes in the stocks. We can measure volatility using volatility index, India VIX you would have heard. And for GARCH modeling, we use the term known as beta, which is used for GARCH modeling. So what are the various terminologies which we use in the volatility? Implied volatility, which reflects the market expectations of the future price and movement of an asset. So for each strike price on option, you have a different implied volatility. So usually at the money strike price have slightly lesser implied volatility, whereas the out of money strike prices generally have a higher implied volatility. Historic volatility indicates the asset post price fluctuation, that is the previous volatility, prior period of 1 month, 3 months, 6 months, 1 year, whatever you want to consider. Then the realized volatility at the end of the expiry period, what has actually happened is the realized volatility. What is the present volatility you are paying the option price for is known as the implied volatility. Which are the factors affecting the volatility? There are sector-specific volatility. There are sector-specific newses which can affect the volatility. A sudden event can affect the volatility, like a war happening, or sudden geopolitical events, sudden interest rate announcements. Then market sentiment, whether the market sentiment is in general bullish, bearish, macroeconomic condition, things like that can affect the volatility. Why volatility modeling is very important? Because if you're an option trader, if you're an option buyer, if you have an increasing volatility, that generally favors the option buyers, because if the implied volatility increases, your option price will increase because it will increase the vega. Whereas if you are an option seller, apart from theta, that is the time decay, which we are not talking in this video, for an option seller, the decreasing volatility will result in reduction of the option price. That is, the change between implied volatility and realized volatility should be a high number for an option seller to succeed. For an option seller, the volatility has to reduce, and for option buyer, the volatility generally has to increase. So modeling or predicting the volatility is a very important aspect in option trading, which has not been dealt adequately, and GARCH model addresses these problems to large extent. So limitation of GARCH model, each model has its own limitation. GARCH model assumes that the relationship between the past volatility and the current volatility is a linear one. However, in reality, it is not true. So we use more advanced models such as threshold GARCH or nonlinear GARCH. And we also have stationary assumption in GARCH model. GARCH models typically assume that the underlying process generating the volatility is stationary, meaning that the statistical properties of the processes remain constant over the time. However, financial time series data are often exhibiting time varying volatility, which violates the stationary assumption. Then we have model specification. GARCH 1.1 model is the most basic model. Then we have GARCH 2.1 model. We also have ARCH model, with inclusion of additional terms. Then we are dealing with large scale data. Then misspecification of the risk. GARCH model assumes that the model is correctly specified and the underlying data generating process follows the assumed GARCH structure. If the true data generating processes deviates from the assumed model, the forecast generated by GARCH may be biased or inefficient. Volatility clustering. GARCH model captures volatility clustering, but they may not fully capture the dynamics and the persistence of the clustered volatility. Then you may also have volatility spillovers. I thank you for watching this video on the introduction to GARCH modeling. I hope you got some insight into what is volatility and how option pricing will be affected by the change in the volatility of the asset class. So next time when you are trading options or when you are hearing this term, please think about volatility and mathematical modeling using GARCH, which will tremendously improve your results. Thank you very much. This is Dr. Narayan signing off.